with that, our presentation today is becoming bankable. Gosh, what does that mean? I mean, becoming bankable. There's a lot of products out there, but with Doug hit on, we're going to kind of try to narrow it down for you today. So.
Yeah, I guess I'll start with saying it's a cool space to be part of. It's when Clark talked to us about the startup community and kind of introduced us to Dusty and Jeff and said there's an incubator downtown that's doing some exciting things. And you two to be in that space. It was real eye-opening for me. I first got involved with the Big Omaha show last year. I came dressed like this. I was very, very embarrassed. So the next day
he's a slow learner.
Yeah. So I ditched it, and the next day came back with my flip-flops and my jeans and the time of my life. But I think the real point is, I think one first match with Omaha, to John's point, it was a 150-year-old company that was no different than the companies years are involved with now or aspire to be involved with in the future. We've got this big tower that takes us some space downtown, but we are very much a startup mentality. And so he said it's important for us to be in that space, to be, maybe the goal here today is not to take away loan applications and fund lines of credit or to be your banker today, but we want to make sure that if you have a question or if you have anything you need for example in Omaha, we'll be there for you. So that's really our goal is to be present on top of mind as a partner for you, not just it's not totally altruistic like John said. We want to make sure you think of us and say, hey, there's a value added partner waiting for you. So,
and I might add one of the other things he made the point of is TD Ameritrade started in our basement. So I thought, that's a very interesting fact. They weren't in our basements very long. They were on it was a hockey stick, but they started in our basement. So there's a lot of stories in Omaha like that, and hopefully we can continue on that.
And we're being coached. We're learning a lot about what, oftentimes, I've been banking 10 years. Someone who's younger in the last 5 or 6, a lot of deals I get are 20 years old, 30 years old. They've got an established balance sheet, income statement, they've got cash flow to assess, and I should learn from it. And so I know kind of the pattern, and what we want to really communicate today is you don't need to operate in that box. I can learn from you, we can learn from you. So it's exciting for us too to say, okay, what do you need? How can we make sure we're flexible and able to be a good partner for you? So the title is, I guess one of our focus here today is to talk to you about what is B2B banking. And really we came down to this, demonstrating the ability to repay the loan. I want this to be very roundtable discussion. Our goal here ultimately is to say, to communicate to you what bankers look at, why we ask the questions we ask. When you come to us, what do you need to have prepared? What do we look at? How do we differ from money center banks? How do we differ from equity? How do we differ from mezzanine type financing? Who are we? What are we? And how can we help you get where you need to go? So the ability to repay a loan, actually we'll stop here. That can be several things. It can be, once you have the cash flow and the income statement and balance sheet prepared, we'll kind of let you and our secrets in our mind as to what we look at and say, this is a good deal, this is not a good deal, here's where we need to go. But even more kind of macro than that, what things you need to have prepared, balance sheets, income statements, financial partners, accountants, attorneys, etc., business plans. The originating documents, your articles, your bylaws, articles and bylaws. What does this all mean? What do we look at? And really, this is meant to be a conversation to let you in on our little secrets here and why we ask the questions we ask. So, stepping back, bankable is one piece of it. So stepping back is a lot of alternative to finance your business. Senior debt's just one of them. So we'll take a step back and John will go through many options you have to fund your business.
Yeah. So we thought we'd say, okay, so we're going to kind of narrow down becoming bankable. We're going to look at the credit side, right? Banks are financial supermarkets. I mean, we've got everything from individual, institutional, corporate products, hundreds and hundreds of products. I imagine you're not here today to learn about, the yield on a money market account. You want to know how do we get money from banks? How do we source financing from banks, right? And so we said, okay, well, time out, because we hear a lot of times, we don't like bankers. They're way too conservative. They don't understand, the growth opportunities my business has. And I think it's important to kind of level set and say, well, where do banks really operate? Where do we come in? And with that, what are the financing sources? So at the very bottom of the capital structure totem pole is going to be your equity, right? The traditional friends, family, fools, right? This is where you're going to start. Once you get there, once you get the idea off the ground, that pre-market type stage, maybe you get some venture capital, maybe you get some private equity, but this is going to be the non-recourse, non-amortizing type sources of financing, right? This is at the bottom. High risk, high return. Okay?
Let's throw the whole slide up there now so we can see some context to what that's like.
Yeah, so with that, then you've got kind of that mezzanine, that middle tranche. The bank has a mezzanine group that provides that kind of middle layer of financing, subordinated, friendly debt. Maybe you have friends and family, maybe you have an angel investor that invests some equity, but there's also maybe a debt component in there. That's where that kind of mezzanine level would come in. And then the third one, that's us. Senior bank debt, that's lines of credit, the equipment debt, the asset-based type lenders. We're at the top of the food chain. It's going to be recourse, it's going to be very, I shouldn't say very low risk, but it's going to be low risk. But with that, if you can hit the next slide, the returns. I mean, this is really what we're talking about when we talk about capital, right? Is the cost of capital relative to the risk. This is our risk return profile. We're in the business of, our cost of funds are probably, depending on the tenure of the loan, our cost of funds are going to be anywhere between 35 basis points, 0.35% on a 1-year type loan, to on a 5-year type loan, maybe it's 130 basis points, 1.3%. We charge 4% to our borrowers, we make 2.5% to 3.5% on our money. I mean, that's it. You know, we get a lot of people who come in and say, you know, we always have this negotiation with our borrowers of what's capital and what's bank debt, right? Because of course you want bank debt for capital. It's cheap, right? But we're in the risk management business, and with the returns that we get relative, you know, Haysbrook down the hall, if he gets 20%, he's not happy. He's looking at, you know, 3x's investment or 4x's investment, right? So it's high risk, high return, okay? And we're not in that space, okay? So it's 4 to 6%, right? So I think it's just important to kind of say, where does bank debt fall, all right?
So I might just add on to that, and John made a comment about being on top of the food chain. I think he just meant on top of this particular graph.
Yeah.
We're very much at the bottom of the food chain,
Yeah.
as it relates to equity investments and insurance capital. So to dumb this all down, essentially, you know, like example, 5 years ago, I had a guy come to me and said he's got a great idea, he's got these baseball helmets, he's got golf carts, he's got all this stuff. He said, hey, I need to borrow $500,000 because if I do and I make all this stuff, Walmart will take it on the contract, it's going to be a cash cow. So all I need you to do is give me the line of credit so I can make it and sell it, and you need is rich. And being young, I came back to my senior loan officer, this is a great idea, this guy's got a great vision, he's got a great market idea, he's got a good plan, and if we give him money, he can make this stuff and sell it and get rich. Well, that's when I first learned about the difference between capital and bank debt. What he needed at that point was capital. He needed someone who's got the willingness and the ability to inject some money into this company so we can do that. We, at 4% return, are not that play. You know, we are there to assist in supplement capital. So we take a well-capitalized company. If there's a timing difference between collecting on receivables and paying on your payables, we can be that line of credit for you. If you need to buy a long-term asset, real estate, or equipment, we can then provide a loan with that collateral or that piece of equipment security. So there is a difference between, you know, that's what John means is we're there to supplement, to assist a well-capitalized company in their growth needs. So there's a song and answer about where does the bank come in. Because often, you know, we'll have someone with that good idea come to us and say, hey, I need bank, I got a good idea, I need the money. We say, hey, we can't do it because the structure's not there. They come out and say, banks don't lend you money. So there is there's a difference between, again, as John said, capital and senior debt. And it comes back to risk profile. What's the risk we're going to take? What the monthly return we're going to get? We don't ask for much. You may think, you know, especially in today's environment. I know you're getting on 0 to 50 basis points on your investments and your deposits, but we're charging 3% for money, 5%, 6% for money. We're somewhat conservative. And so, getting back into now, after we kind of prepared down from that macro level of what ways are there to fund my money, to fund my business, family, friends, equities, subordinated debt, or carry-back type notes. When you buy a company, you borrow from the previous owner, then ultimately bank debt. We're going to take this down and draw on bank debt. So once we decide on senior financing, what types of options are there? Okay, now that I know I go to a bank and I say, hey, I need some money, what we're going to ask is what for? Is it to support working capital returns? Is it to support your inventory, timing differences, your receivables coming in? Or is it to buy a piece of equipment? Is it an acquisition of? Is it to buy a building? Depending on what the use of that fund, the use of the fund is for, we'll provide structure. So loan type, short-term, lower than 12 months, that's often a line of credit. We offer a line of credit secured against inventory receivables. As you go out and you You give terms to your customers, you have terms to suppliers. Will be the line of credit that can supplement that timing difference. Purchasing cards and credit cards are a great way, and also very synonymous with our lines of credit. We generally, as I said, secure those with receivables inventory, because that's what we're funding. Funding inventory is funding receivables.
And what Doug's getting at is what we're trying to do is match the useful life of the asset with the term and or amortization of the loan, right? So if I'm converting AR every 30 to 90 days, right, I'm going to match that with a short-term line of credit. If I've got a piece of equipment that might last 10 years, I'll have a 10-year term on the note, right? So the key for you guys is you don't want to be upside down, so to speak. You get a 10-year note on a 3-year asset that you have to turn every 3 years. Now you're upside down on that piece of equipment. So we're always trying to match the useful life of the note or useful life of the asset with the life of the term of the note. So there's some receipts up there.
Yeah.
Yeah, help yourself. It's very informal. So
Yeah, and please stop us at any questions you might have or clarifications you might have, because we see this every day. I think I'm somewhat concerned that we may be speaking too high level and maybe going somewhat quick, but and also trying to concentrate not diving in on too much, because I know you guys are entrepreneurs and business owners and you guys have a good idea how this works. But the other half is long-term debt. So this is when you come to us and say, I want to acquire a business, we're going to amortize that over 7, 10, 15 years. Purchase equipment, same thing, useful life. And most often you're going to buy a building 15, 20 years. And, you know, it's not always going to be, you may come to us and say, yes, you know, I want to borrow to buy the mortgage on the building, or I want to borrow, you know, say $500,000 to buy this building, and we're going to amortize over 20 years. You'll often see the bank will do a 5-year type note, 15-year amortization. And what this does is helps us manage our interest rate risk as well as yours. So it's a balloon loan. We'll oftentimes not go out. Banks aren't real comfortable going back to that risk profile and going out much longer than 5 years, sometimes up to 10 on really extreme circumstances. So there's different ways to structure it. Again, this point of the slide is just to say, we listen to you. What are your needs? What are your uses? And we'll find a structure to meet those needs and those uses.
So we talked about the financing sources, the financing uses. Now we thought we'd kind of just give you a little insight, and not that you need to become experts at credit underwriting by any means, but maybe this will help to give you some sort of perspective as to how we would look at credit. I'm sure most of you guys and gals have heard the term 5 C's of creditworthiness, right? And this is what it boils down to. When we put together loan packets and we determine whether it's something bankable or not, we're really underwriting these 5 C's of creditworthiness, okay? And so those are our conditions, capacity, capital, collateral, and character.
How many have heard of this before? I don't know if this is banking school 101 or managerial banking classes, UNO or UNL. It's somewhat cliche, but it's silly in some ways. And we say we laugh at it when we talk about this in one committee or at work, but it really does cover everything. When we look at someone who wants to borrow money, we look at all factors, and they're all extremely important.
So you can answer. So to boil down, this is extremely busy, and I apologize, but that's a good segue into if anybody wants this presentation for reference purposes, shoot me an email, and I'll have part of it, pass them out. So then you can have this as a reference. But as we talk about, Doug, did you want to maybe talk about conditions?
Yeah, exactly. I think, the 5 C's are kind of a catch-all. I mean, you got condition, capacity, capital, collateral, character. And so we're going to kind of start with the conditions piece. And what I mean by conditions is, what's the current environment on a macro standpoint? If you come to us, whether it's printing or manufacturing or service industry, or you're selling pagers, you may have great historicals, but I don't know that pagers have a future necessarily given the technology environment. So we look at a macro level and say, what are the trends? What's the economy doing in the marketplace in which you're serving?
How cyclical is the business, right? I mean, we've got a lot of ag manufacturers or ag-related companies that are absolutely killing it right now. Are we going to underwrite to today's, I don't want to say bubble, but today's kind of peaks, or are we going to kind of try to find some sort of average, right? So the cyclicality of a business is important.
And so it's going to take, instead of questioning the numbers that may be evident on a balance sheet, it's taking a step back and say, okay, this is what's almost like the smell test. What's this, put your finger out the wind. What are the economic conditions? And really the most important, I think that's really important, is the competitive landscape. Who else is in this business? What are they doing? What are the barriers to entry? So it's kind of taking a look on a macro standpoint of what we're trying to
On capacity, that's also synonymous with cash flow. So what can this business support? So if you're a startup, what does your pro forma say? What is the market size and what do the pro forma say about your ability to service the new debt? You know, whether it's a line of credit, we're talking just maybe interest payments. If it's a amortizing term note, we're talking interest and principal. And how does the cash flow of the business cover the required debt payments of this proposed note? So cash flow is really important. I mean, it is next to maybe character and collateral. It is very, very important because it tells us what our repayment source is. The primary repayment source on all of our loans is cash flow from operations.
I'd say aside from character, probably is the most important. Cash is what pays us back. So all that really is the ability for the borrower to pay us back. What's the cash flow look like? On the capital standpoint, this goes back to, again, that risk profile. We want to make sure we're making a well-capitalized company. Being we're making a loan on a line of credit or a certain debt facility and earning a minimal amount of interest on that, we want to make sure the balance sheet can support that debt. And there's a couple ways we measure that. We'll get into that in a little bit. We have an example, kind of case study of a true balance sheet initiative to tell you how we really assess and monitor each of these 5 things. So when we say capital, we just want to make sure there's an appropriate amount of capital and equity in the business to support the debt. We want to make sure that total liabilities to total equity, total debt to EBITDA or cash flow. So capital is extremely important, and it comes back to retaining those earnings that go short. Either startup capital, injected capital, paid-in capital, seed money. But then as you grow your business and hopefully have a profit and retain those earnings, we want to make sure that there's a nice nest egg to take care of any cyclical downturns or any unforeseen circumstances, maybe a bad debt, a receivable that doesn't pay. That's a very important part of what we do, is looking at to make sure the balance sheet is supporting the growth.
So the fourth C would be collateral, and that really represents the pledges on hard assets that you make to support the loan. And this is really by way of a second and tertiary repayment source. We'll get into that in a second, but we talked about lines of credit. Very common in our industry are working capital lines, and those are lines of credit to fund timing difference in the receipt of accounts receivable and the growth of inventory. We fund kind of those differences, right? So whatever your cash cycles are, typically you're going to need some sort of support by way of a working capital line. We're going to take a blanket filing, and maybe we should have went into this in more detail, but what a bank will typically do is file a UCC financing statement on the business. And it'll basically say the bank has rights to all business assets of this company. And that's up and down the line and even including tangibles. But generally that's what you're going to see from a bank structure is a blanket filing on all business assets. And so those are really in addition to personal guarantees, those are kind of our backup sources of repayment should things go wrong.
Now, none of those four matter if character doesn't meet our threshold. The character can be several things. It can be the type of business you're in, the industry you're in. We're a privately held bank, so it gives us some neat flexibility, but it's also we have a brand and a reputation to uphold. That no different than any other business. So you can have the financial conditions to work themselves to great growth. You can have the cash flow coming out of everywhere to make sure you service your debt. The capital is there because you retain your earnings and you grow your business. And the collateral is there because you've got the building, you've got the equipment, you've got these people support. Gambling, well, let's say, the adult entertainment. It comes out asking these are met. We're going to say no, it's not what we do, and we choose not to. There's a character, and that's an extreme example. But it also could be the fact that you've got a good business with good growth. And 2 years ago, I happened to be at a golf game and cheated on a few holes, and I just don't like being where I don't trust you. So character is extremely important, especially in a small town like Omaha. That's got the ability to put things together like Mastercraft and leverage relationships. That's the most important piece because that's really the relationship aspect of it. And again, if you meet the threshold of the industry that we're doing, if it's an industry we want to work with, the person we want to work with, we also want to make sure that you have the ability when you're making your financials. You have a good insurance, you have a good account, you're willing to disclose to the bank when the time is good, and the times are bad. Here's what you envision going forward. So character is a big piece because it really is the threshold, the foundation, for the relationship. The relationship is the biggest, is what we do. We manage relationships, we partner relationships. So more or less to kind of round out this slide is if you were to say, okay, I have a small business, I am renting space, or I'm looking for space, or I want to buy a building, I want to buy this pretty person. do you do? Well, I buy markers and I buy paper and I sell posters, okay? So I sell signs, okay? And how do you generate cash flow doing that? Your revenue, your expenses, is your income. You generate enough cash to service that debt we're going to give you. And does your balance sheet support the request? That's the capital piece. And then bankers, because we're somewhat conservative and because we're looking for 4%, not 40%, we're going to look at a secondary source of repayment, so that's the collateral piece. Okay, if this doesn't go like we think it will, the cash flow doesn't sustain, what type of collateral can you pledge? Short-term, it's going to be your inventory receivables. It's like pledge those and we'll cash those if need be. Long-term, it's going to be that piece of equipment, that printing press, or that building you're now occupying. So that's just kind of a holistic view of what we're going to look at when we talk to you in that first meeting. Do you need these? Now the kicker is, you don't need to be on fire. And one point that I want to make sure John and I both make is, in a perfect world, we would. In a perfect world, too, we all make a bunch of money, we never have a bad loan, we wouldn't be in a financial crisis from the East Coast, etc., what have you. We don't need to be on fire. You know, our president of our institution one time kind of likened it to, you have to use a golf analogy, but we like to be in the fairway, sure. And hitting the flag means we put you in the fairway. But just because you're in the rough doesn't mean you're not bouncing it. You know, there may be situations where the cash flow is there, but maybe there's not a collateral backing up because it's an enterprise, it's a service industry. And so there's a kind of enterprise value to that business as opposed to tangible assets. But we'll look at that. And what we'll do is, okay, let's just make sure the cash flow is super strong. Let's make sure we've got the right structure in place. Let's make sure we get a guarantee from business owners so that they can commit to liquidity if need be. So we can be very flexible around the 2 or 3 that we look for. I will tell you, this is always a must. You've got to have character. The other 4, we don't need to do all the time. So we can be very flexible, and that's the message we give you. We don't operate with lines. In fact,
yeah, we made reference earlier to the French family fools as a source of equity. Don't forget, bankers can be fools quite often, and we were fools during the recession. I mean, we made loans that we maybe should or shouldn't have made, but we thought we met all these, you know. So again, it goes back to that character, but really being able to tell your story as a banker. Right? I mean, I think it's really important. I mean, the relationship and communication is huge because especially with local banks, if you can get them to commit to your business, I think you'd be surprised at what they're going to finance.
yeah, it comes back to that. We'll get to what you need to do to prepare, but it comes back to that presentation and that relationship. If we feel comfortable with your vision and the ability to run your business, we're not going to get in your way. We want to be there to help, but it doesn't matter. But in addition to the need talks, 4 or 5 years ago, there were a lot of bad loans. And somebody at one time said, you got to go to Las Vegas, you got to go to Phoenix, and you got to go to all these Florida and build houses. And on paper, it made a lot of sense. What people didn't have to handle on was the conditions. Now, there's not a lot for some things, but that's why we at the National Bank operate with John and I make loans. We always joke about, within a shadow of a doubt, most of our homes. We know the business owners. We sit across the table from the CFO and mom and dad, mom and pop, etc. We're not in the business of financing a business in North Carolina or Portland, Oregon, because we don't know those conditions. We don't have a handle on it. So it's really an art. It's not a science on how we look at these credits. So sources of repayment. Then we'll kind of get back into some ways we measure those 5 C's.
Yeah, we can just really high level touch on this. I think what differentiates, say, a senior bank underwriter and even an equity underwriter, Nick over here, he's going to do a lot of those C's. There probably isn't going to be collateral, but those C's, conditions, capacity, character. A venture capital firm is going to do that exact same underwriting, right? They probably won't have the collateral side of it, right? But the real difference here that's going to differentiate Nick and I, or Doug and I, to Nick, is going to be the source of repayment. So we talked about the primary source. That's going to be conversion of current assets to cash and cash flow from operations, right? So we're always going to have that. And then it's going to be the second and tertiary, liquidation of collateral, right? If we have the building as an asset or as collateral or the AR in the inventory, and then tertiary is going to be guarantees.
Let's give you some perspective too. There's 1, 2, and 3, and certainly we have. I love if we had a slide draw line if you want to do. I've been in banking for 10 years. I've been lending money for 6.5, and I've never gone to the second. We're not in the business of saying, oh, we got this, we have the second, so let's make decisions based on the fact that we can always go to that collateral. we operate going concerns. We bank going concerns. Our goal and job is to make sure we all get together and keep this going. So it's really a contingent second and third source of repayment. So really, we look at this, okay, is your primary source of repayment? Doing what you do, does that allow you to service your debt? And that's how my goal there was to give you context, because I think that's a good question. I don't know the answer. How often do banks hit that liquidation? Or, you go through stories about repo. We're not out at 2 in the morning dressed like ninjas taking back cars, or unlocking the keys to a manufacturing plant taking back equipment. I don't know if that.
We all lose in that situation.
Yeah, nobody wins. Yeah, exactly. So we take a loss.
Maybe the Coley guys do. There are ninjas.
Yeah. But just so you know some context of how we approach this and what happens within a bank, very seldom we do a second level. We do people know about it. It's not very fun.
Yeah. So we talked about the underwriting. Does anybody have any questions on that? Hopefully we're down in the weeds enough, but not too much yet.
Yeah, so you talked a lot about the relationship and you know the company. I guess one question I have is, when is the right time for a company to come in and approach the banker? I mean, is it when you're ready for a loan, or is it 6 months or 12 months before you're ready for a loan, so they can actually get to know you and see you grow? When is that right time?
And you basically caught us on something that we should have covered at the beginning of our presentation. And really our objectives here would be both. I mean, hopefully you're either in a position where you probably are bankable, but maybe you don't have, one aspect of the C's and you need to refine that or kind of think through that or put together your business plan. What I would say is, a meeting with Doug or I is never too early. I would say make sure you have your business plan and you have your pitch, so to speak, refined. But if you come to us and say, here's what I'm looking to do, here's the loan that I want, and we say, gosh, you meet 2 of the 3 criteria, but here's what you need to do. We want to be available to be advisors to you. So a lot of times it's going to be, man, you're almost there. Here's, maybe you need to go talk to your accountant and, work through these kind of aspects on your balance sheet before we get there. But I guess the answer to your question is never too early.
Because it's a conversation.
Yeah.
And I don't think that we've got a spreadsheet with 5 criteria to look at this next week's box. This is just it's education. It's the way that we kind of how we look at things. But we've got colleagues that call us and say, hey, I've got a great idea. My brother and I have been making salsa for years, and we want to start, really taking this to market. We want to get a packager and a supplier and distribution network set up, and we want to buy a building. What do I need to do? And so at this point, they have a business plan, and that meeting is perfect. Because we say, okay, in order for us to get across the finish line, not maybe 24 months from now, here's what you'll need to get there. So your meeting can be, Doug, you have 30 minutes over a cup of coffee to talk before I want to go. And that's right. If you're there to say I need money next week, that's when we need more of the formal presentation and say, okay, we got to make sure that if you have a lot going on in your house, we need windows on the house so we can see it. We need to make sure the cash flow is there, the sources of repayment are there, your capital as well to support all this stuff. Everything we talked about.
Yeah.
There's never too early because, again, the more discussion, the more communication, the better partner we can be.
And I guess I had who I think is a very brilliant entrepreneur that we work with, say, your objective out of your presentation should be, look, these entrepreneurs have a lot on their plate. They're the jack of all trades, they're wearing a lot of hats, and if you present the idea that they could potentially get a bank loan and they have no chance of getting a bank loan, then you're doing them a disservice, right? They're wasting time and energy on something that they otherwise shouldn't. So I guess to answer that question, if you look at the 5 C's, you look at your business and you say, I do not have the capital and the collateral right now, you're probably not there. You know what I mean? Now, that being said, there's credit enhancements like SBA loans and things like that. So if it's a 30-minute conversation or a cup of coffee with Doug and I, that we look at it and say, gosh, maybe we could support this with an SBA loan. Let's look into this more, and hey, think about refining this a little bit. It's probably not worth not a waste of your time, but I also, for fear of kind of sitting on the wrong path and wasting time on things that you have better use of your time for, there's opportunity cost to that. So a 30-minute conversation is absolutely worth Doug and I's time, and probably worth yours. But look at those 5 C's and compare those to your business plan. We're going to actually, if you could flip the next slide. So we talked about the 5 C's, and this is a good segue into this. Your business plan, and here's kind of the should speak to the 5 Cs, right? And like I said, an equity person is going to look at very similar, going to do the very similar underwriting, and so you can cover both bases, both an equity request and a debt request with the same business plan, I think. You know, you might change some of the executive summary and organizational background type stuff, but it's very similar type of structure. So, credit request, we're going to...
Yes.
Sorry.
I'm sorry.
No, you're fine.
I just wanted to put Zach Zimmerman's contact information.
Yep.
He is the center director of the NBDC in Lincoln.
Okay.
I am the center director of the NBDC in Omaha.
Beautiful.
And I have business cards, so I'll make
Okay.
sure you guys have that. So
Yeah.
you don't have to call Lincoln to get assistance.
Okay.
Just want to throw
Fantastic.
that out there.
Yeah, that's great. I mean, so, and what's your name?
Aretha?
Aretha. So, there are resources to help you write your business plan.
Zach gave us a call, and it was, we were thankful for it, so we said, hey, we gotta just give an example for someone that can call. This is great. Please do.
We're going to pass these out real quick. Zach, name Moses, is in it right? Kevin, yeah. Provided me with this functional business plan, kind of Q&A type thing, or questions that you should consider in your business plan. I think it's a great resource. So, in conjunction with Aretha's help, this is a great place to start too, right? And the next slide will talk about some of the contents that you should have in your business plan. But here's really what we're going to ask for. We're going to ask for 3 years of financial statements if you're an existing business. If you're not, we're going to need the pro formas in the business plan. Current AR and AP. Again, if you don't have that, we're going to look to the business plan. Sources and uses is huge for a startup, especially. What's going to be funding working capital? What's going to be funding more long-term assets? And really understand that connection between the useful life of the assets and the term of the note. And then again, Doug referenced earlier your organizational thoughts. Then as you drill down further, we're going to request owners and partners personal financial statements and their 2 to 3 years of personal tax.
And again, not to say you need this for the meeting. This is just what we're gonna need before we can make a decision on credit. And then most people will. So certainly if you come and say, here's my idea, we'll push it. We'll say, here's what you're going to get eventually. Now again, obviously if you're new, you don't have to use the historical financials, but this is where, when we, is it, you said Aretha?
Aretha, yes.
Yeah, no, Aretha, or Mr. Zimmerman, or the SBA, we see deals. So you come to us with respect to your time, and everyone, as John pointed out, get in your way, to slow the process down. We might be evaluated because we've seen opportunities, we've seen deals, we can say, hey, get where you want to go. You may want to talk to someone like Aretha. So this is not a requirement for meeting number 1 by any means. On a business plan, and you've got the handout, this is what we're looking for. Background information, what's your marketing efforts going to look like? Your operational, what do you do, what do you need? Who's going to be there for you, what will their roles be? And on a financial plan, we're going to look at historics if you have it. If you don't have historics, we might look at what you've done to assess the risk out there. So what are other people in your industry doing? Okay, then based on your current structure, your current resources, what are your forecasts? What do you think is going to happen in 2013, 2014, and beyond? And so this is all part of that, us understanding what your business is. You have a parking quote, something like that.
Yeah, Mike McCarthy always says, and they're on the equity side, but, what is the definition of underwriting? It's understanding the business and writing it down, right? And that's what we're trying to do, and that's what you're doing here. You're understanding the business. Things like break-even analysis, or we'll talk about it maybe in the next slide, but what are the levers of your business? What drives your revenues? What drives your profitability? Where's your break-even? What portion of your business is variable costs versus what portion is fixed, right? What are your marginal costs of producing the next good? I mean, those are things that when you come down and sit down with your banker and you know that stuff, that's impressive. Because I'll be honest with you, there's not a lot of people that do, but the people that do are the good ones. Those are the guys who go, man, this gal or this guy, they know their business. We want to bank.
There's $50 million revenue companies who don't necessarily have that type of analytics in their mind.
Right. But if you can understand that, I think those are ways to go above and beyond. And those are situations where you hear about, these entrepreneurs that say, hey, they're like at First National Bank because he banked me when nobody else would. And there's stories like that, but it really comes down to when you come in with your business plan and you know your business. I mean, when you truly know your business, it's exciting for us to get on board. So.
You Yeah, because we gotta utilize our assets, we've got deposits, we've gotta utilize our assets and get return on it, so we look at who do we partner with, and maybe there's only one C you cover, two C's you cover, and we say this guy, this gal has their stuff together. You know, let's go in a little bit, let's take that chance, not to say we're taking chances, because again, we're kind of operating a little bit, not like a venture capital player, but against senior debt player, but the point is, it certainly does help the cost.
So I jumped ahead a little bit, but again, financial plan, like I said, know your metrics, know your leverage, know the inherent risks, right? We're gonna say, well, you know, typical question, well, you know, what are the substitutes? Why isn't this out there today? Who, you know, what is the competitive advantage that you have over your competition?
Real quick, John, we're gonna ask you questions, and to me, it's the most humbling part of the job. It's scary. I mean, I want to look intelligent. I want to look smart. I want to think you got a good partner in me as a banker. But one of my first questions is going to be, what do you do? I kind of think I know what you do. You're a printing company, or you're a manufacturing company, right? You walk by your office at the Mastercraft building, I can see that you're a consultative innovation, but what do you do? Help me understand what it is you do, and how that turns into money for you and a lifestyle for you, and how you would taste that if you were to borrow money from us. So we're going to ask questions, and it's on us to make sure we're respectful of your time, respectful of your business, but the questions are not the challenge by any means. It's just for us to understand so we can be a good partner and not be a waste of your time and guide you in that direction. So.
And then the last thing, the critical bank ratios. These are really kind of the four that I think you should definitely have in your business plan, right? Because you've got the conditions, you've got the management team, and then we look at these four ratios, all right? And that kind of gives us the fairway to talk about, so to speak. Now these ratios, the levels of these ratios change based on industry. If you're a service provider, if you're a software development company, your current ratios are probably going to be higher because you're not going to be financing a lot of inventory, things like that, right? You're probably not going to have as much term debt because you're not going to have much equipment and things of that nature. But if you're a manufacturing company, you're going to have more term debt. It's going to be a capital-intense business. So, you know, debt to tangible net worth is probably going to be higher, right? So these fluctuate based on industry, and we look at them based on the industry, and we take sample sizes of companies across the country and even locally in our region, and we compare it. We say, how does that compare to, you know, the 50 other companies that do software development?
Not to mention a $500,000 company versus $50 million company.
Right.
You know, we're not just going to say it's got to hit 1.25 debt service coverage or we're not going to deal. Because we know what makes sense for you may not make sense for you.
Right. So
let me go back to that actually real quick. Because I guess the goal of showing you those ratios is to kind of say, okay, we talk about, you know, conditions and character are there, that's most objective, correct? But when we talk about capital, we talk about capacity and cash flow. How do we know what good cash flow is and what good capital levels are? This is exactly how we gauge it. So, you know, the first one is time and capacity. We just take your free cash flow, your earnings that we add back to non-cash expenses like depreciation and amortization. We say, here's the cash you're generating from your operations. Here's the debt you need to service. Are you comfortable with that? Are you over 1-to-1? Can you do it? Okay. And then also, we like to, you know, make sure we're comfortable with, so maybe it's 1.25 times. Yeah. Current ratio. What should liquidity look like? If there were a rainy day, if this were to slow down, do you have enough for your current assets? So you can do your current assets, see your current liabilities to the point that you've got a good balance sheet.
and that represents liquidity in the business.
Right. It's liquidity. Leverage. Take the total debt. No different than we looked at our personal financial statements and say, okay, how am I doing? We look at your total debt load versus your equity. We want to make sure that's usually it's 3-to-1. It's kind of the high end. For different industries, it may be 4.5-to-1. For some, it may be 1.5-to-1, depending on what business you're in.
And when you think about it, sometimes it's helpful to think about it in terms of a home mortgage, right? Most of us in here either thought about doing it or have done it. When Doug said 3-to-1, that represents 25% equity, right, in the business. Okay, so generally that's a good proxy. 20 to 25% of equity that you have, we talk about the capital, into the business. Now, that can fluctuate based on credit enhancements, SBA guarantees, and that nature we'll get into, but that kind of gives you a good proxy.
I think it's interesting because you know, when you get into it, you know, we're saying 3-to-1. Now keep in mind that's for every $3 of our money, we're only asking for $1 more. You know, so sometimes they say, God, my bankers ask a lot of questions, or my bankers seem to be wondering, you know, why my collateral's out of margin. Well, again, we're willing to get this to a plan level that says we're going to put 3 times the money you're going to put in to help you support your business. And you're going to retain earnings and grow, and hopefully you have a generational wealth, right? That you pass on to your grandkids. And we're looking for a 4% return. And so we like to think we're a good partner and that we're out there, but that's kind of the reason we do ask those questions is because we're putting a lot of our capital to help support your business.
So we thought we'd throw, this is one of our companies, just general case study, and this is their balance sheet at 12/31/12, their income statement, and then those financial ratios we talked about, right? So as we work down on this company, the one thing you notice right off the bat is this company's got very strong working capital. And how do I know that? When I take total current assets, 6.2 million of total current assets, accounts receivable, inventory, and then some others there, miscellaneous. 6.2.
This is a 3-page balance sheet that we condensed in about 5 lines.
Yeah, but total current assets, 6.2 million, right? And total current liabilities of 2.8 million. That is, in the next 12 months, they have $6.2 million of assets that are going to convert, and they'll be expected to pay 2.8 million in liabilities, whether that's trade payables, whether that's interest on their line of, whether that's the entire balance on their line of credit, and then the current portion of their long-term debt, which is here, right? So this company is very liquid, right? If things slow down tomorrow, they have a lot of margin of safety to continue to keep the lights on and pay the bills, right? So working capital, very, very important.
And just an interjection too, because I was thinking what you guys might be thinking or asking. This is even somewhat conservative in that the norm is to offer a line of credit. It's usually a 1-year commitment. But the norm is that that's renewed every year. The line of credit is short-term in nature. Short-term recurrent assets are supporting it. We give you a 1-year commitment at a time, and that's usually renewable every year as long as things are still on the oven. So don't think that lines of credit from a bank's perspective means you can borrow money to support this and that. December 31st every year you got to pay it down to zero, because that's not the norm. That's not the case. It's perpetual most often, given the fact that your conditions are in order.
The other thing that we point out right off the bat is the total equity in this company, and we like to look at tangible net worth a lot, and that's total tangible assets over and then you subtract out the liability. So this company has 2.7 million in equity in the business, right? And when you compare that to the debt, the 1.3 and the 1.8 plus the current portion, and you divide that over tangible net worth, that's 1.73, right? So again, we're comfortable with about a 3-to-1 ratio, all right? So again, this company is conservative. We probably could have came up with a better example that was probably a little more aggressive. Our problem was we went through most of our portfolio companies, and none of them fit in that 5C box that we talked about, right? I mean, that's the ironic thing about it is we play in this kind of, we play on the golf course like Doug said. Most of our companies don't fit in the fairway. They just don't. You're entrepreneurs. We get it. Nothing fits in the box. We can be flexible, but
there's a structure for every request. You may come and say, I got no collateral. I've got a lot of cash flow. We'll find a way to get it done. It's got to be mutually beneficial. And that's an extreme example. When I say there's a structure for everything, aside, given characters there, it just may be if you're missing collateral or you're missing some sort of cash flow, there's not enough capital in that deal, we may structure it in a way that says, that's a possible thing, I can't do that. That's a probable case. It's got to be somewhat norm, but we can structure anything. It's just a matter of, is it mutually beneficial for both parties?
So, I mean, that's pretty much the extent of it. I mean, we look at EBITDA a lot. If it's a manufacturing company, we might really consider the CapEx of the business, right? The fluctuations in working capital. If it's a software development company or a studio or something like that, the CapEx is probably going to be limited. So we're going to probably look at the earnings before interest, taxes, depreciation, and amortization. So we're going to adjust our analysis a little bit based on industry, but this is kind of the financial metrics behind what we had talked about.
Yeah. And so to conclude again, capital, debt's net worth, rock star. Funded, no. When I say debt, by the way, it's total liabilities to net worth, as John pointed out. The debt to EBITDA is funded debt, so we're actually taking that contractual debt, whether it's with a carryback note, with its subordinated debt to mom and dad, or it's bank debt. It's contractual debt versus your cash flow, or EBITDA in this case. And then John pointed out current ratio. So these are just ways to assess the capital and the cash flow. And then collateral actually is not necessarily on it. We want to make sure if there's a line of credit that the inventory and receivables can support that. We want to make sure if it's long-term debt that the balance sheets were in the form of these fixed assets down here, or as we just kind of summarized, long-term, buildings, land, and equipment. So, and this is a snapshot, mind you, too. Usually we would have 3 or 4 years and do some trend analysis as well. What was it like last year? What was it like 2 years ago? Hey, what happened here? Could it happen again? So it's very much a trend
In
analysis.
a startup situation, that's going to be forward-looking, clearly.
Oh, absolutely.
So, again, just to, any questions on that? I mean, I think this is, we want to get you guys out of here. I think this summarizes how we look at it. I mean, we went back to when we talked about the business plan, understanding your financial metrics and your ratios. This is what we're talking about. I mean, just be able to talk through it. Be able to understand your financial statements.
And it's not the end all. Never will we look at this alone and make a decision. It's always going to be a relationship. What are you doing? Tell us what we're not seeing here. Tell us why you make income, maybe a loss of $300,000, but there's a one-time expense that you took a loss on a sale of an asset so you could have a tax. It's good tax flow. And you made a very mindful decision, a very fiscally responsible decision. Well, it looks like things are bad. They're not. So we never, this will not paralyze us. That's going to be our commitment to you. Is there's a conversation we had, a relationship we have around this financials.
Any questions on that? On that last one? You guys are tired, man. Very intriguing thinking, Steve. But so all that said, there's lots of opportunities out there, as we call them, credit enhancers, and those are by way of government-backed loans, maybe they're grants, things of that. Aretha, you talked about that. She'd be a great resource for you on that. Our next seminar that First National is putting on is going to be March 6th, and we're going to dive into SBA lending, 7A, micro lending. Kevin down in Lincoln, who's with the Community Development Corporation, specializes in micro lending, and that's loans less than $50,000. So great for startups, right? And the application process is streamlined, from what they tell me. So I think one thing to know. First National Bank's a PLP lender. We make all of our own credit underwriting decisions when it comes to SBA lending. So we'll get into that on March 6th and kind of hash that out. So something to think about is if you think you're lacking some of the 5 C's, credit enhancement is a great way to supplement, bolster that.
And it's a growing organization. It's been really good. This administration of fire did a nice job. It used to be going to be so big with capital or your earnings. They've expanded to what small business means today. So a lot of folks are eligible for this, and certainly I think most people in this room would be, and that's a great way to get into lending. Because what that does is say, if the bank wants this, maybe it's not over there, and in a traditional standpoint, we couldn't get it done, but we grab that credit enhancement provided by the SBA, provided by NECO, what have you, when we need it done. Such a great opportunity. And I want to introduce too, Jeff Ash is here from our bank. He's a business banker at First National Bank. He focuses on a lot of these credits just like this. So, and then Rob Clark is here as well, who partners with Rob on the community banking side. So there's tons of resources, and just want to make sure that you guys get there as well.
When's the next seminar? 2 weeks. 2 weeks, and you know when it's over? 2 weeks. Sorry, that's really the question.
Taking advantage of state tax incentives and credits on lots.
Let's going to go over state tax incentives. So that's in 2 weeks. We got it in place. So any questions? I mean, there's a lot to go over. Yes.
Just in general health, let's say that you've got your 5 C's all lined up, you're ready to go walk in. How long's the process take?
You have all 5 C's? About 2 minutes.
Yeah. No, I mean, I'm
showing you.
Yeah, but to Doug's point, we can look at a deal and say, this is done.
Yeah.
Right? If it's hairy, it might take 3 weeks. We have a very flat approval structure. There's, this is kind of an egregious attempt to differentiate ourselves from our competition, but our decisions are made locally. Between me and another guy can approve $500 loans. So, for the most part, especially with our efforts with Mastercraft advisors, we have the ability to make a decision very quickly. If the structure's loose or hairy, it might be a 3-week process. There might be a back and forth. Hey, provide us this, give us that. Let's talk about this. Did you notice this? Okay, that's your mitigant for this. And so it's going to kind of go back and forth. To Doug's point, it can be as quickly as a week. To get to documentation is probably 2 weeks, as long as 4 weeks, 5 weeks. I mean, it's
reality.
We're not sending our approvals to Minneapolis or to San Francisco. I mean, they're here.
But you'll have a good idea within the first meeting. You really will. Or call back after you've had a chance to assess financials and says, hey, this looks good. Or hey, this is great, but And certainly, hey, we've identified this as something we want to do, we need to get SBA involved, and certainly if there's a third party involved, it just may take longer because then they have their own credit underwriting. So, but the process may take longer than we like, but the decision will not. So you'll have an idea, our commitment to you is to say, hey, this isn't going to work, and here's why. Hopefully we made you better off for it, or yeah, it's something we want to do, here's what we're going to do. So,
And what usually happens is we put it in the form of a term sheet, no different than a VC term sheet. And, here's a term sheet, it'll outline generally what we would, under the guidelines, we would provide a commitment. If you say, I'm agreeable to that, we put it in the commitment form, sign it, and then we work towards documentation.
and we're always open. I think the bottom line is that we're very accessible, and that's one big part of Mastercraft, because we wanted to make sure there's a channel to approach us versus, going from the administration's, the desk at First National Bank's tower and ask for a commercial lender. Stop by.
We're here Thursday afternoon.
Yeah. And if we're not here, talk to one of the folks that are and just say, hey, ask some questions.
Yeah.
It's nothing too small. There's no silly questions.